What's next for markets?
I'm Michael Kantrowitz, Chief Investment Strategist at Piper Sandler, where I lead the portfolio strategy team, recently ranked number one on Wall Street in the 2024 All America Institutional Research Survey. In this week's episode, we'll be discussing the tech sector and the similarities and differences between today and 2000. Once again, I'll be speaking with Stephen Gregory, my long-term colleague, who heads up the quantitative research effort at Piper Sandler. Hey, Stephen.
Hello, Michael. I'm excited today to talk about tech. I think it's an interesting conversation. You've seen so much outperformance in tech recently, and there's a lot of conversations out there about how tech is and isn't different than 2000. And you definitely have a lot of people on both sides of that conversation. So I'm really excited to talk about this one. How are we going to attack this? Because it's such a big conversation. You could go in a million different directions. What's our game plan today?
Yeah, so I think we want to acknowledge, right, tech's done really well the last couple of years. And I think we want to, like you said, there's a lot of people on one side who think it's a rhyme of 2000 and there's tons of speculation and the market's going to crash. And then you have certainly folks on the other side that say this is the very beginning, i.e., we're in 1995 or 1996 of this multi-year cycle. And so I think, the value we could add today is highlighting some of the differences, and particularly those in the fundamentals, as to think about what are the risks to the sector and, ultimately to the market. Tech comes up in every single conversation at every single meeting because it's such a huge part of the market composition, the Mag 7, of course. And so, when we look at the largest 10 stocks in the S&P 500 today, they're almost 40% of the index. And only 2 years ago, the 10 largest stocks were 30% of the index. So that's a 30% surge in the weight of these large stocks.
That's a crazy number, 40% of the index. It's a conversation worth having. I see why people are talking about it. This would be interesting. I think fundamentals is the great way to tackle, kind of one of these comparison conversations, because you can have opinions in every way and say it's different this time, it's not different this time. We're different innings into it, but fundamentals are fundamentals. At its core, that's a big driver. I think it's a great way to tackle this problem. And you got to that 40% markets because tech has been on a tear the last couple of years. I think the sector itself, the GICS sector in the S&P 500, I think the sector's up over 100% in the last 2 years. It's definitely been leading the way.
So similar type of outlier performance. And for comparison, if we look at the weight of the 10 largest stocks in the late 90s, we got up to a high of around 26 or 27%. So just to contextualize that was the starting point right before COVID of the 10 largest stocks. So basically from 98 through 2000, March of 2000, the 10 largest stocks went from about 18% to 27%. One of the things that's interesting, we talk about market before we jump into tech and we talk about market concentration, is that we are seeing something today, this massive concentration in the large cap S&P 500, but you're not seeing it in mid and small caps. The largest 10 stocks in those two indices are really nothing to write home about. They're both at around 7 or 8% of those respective indices, the mid and small cap indices. What was interesting that if you look back at the data in the late 90s up until the peak of March 2000, the largest 10 mid cap stocks went from about 10 to 20% in 1 year in 99. And even the largest small cap stocks went from about 5 to 13%. So you saw a rising concentration in 99 and 2000 across size indices. Today, we're only seeing it in the S&P 500.
That's interesting to point out. We haven't seen anywhere near the type of concentration risk in the mid and small cap space that you are seeing in the large cap space.
And I think we're gonna give away a little bit of the conclusion here, which I think is probably obvious to many. Is the reason I think you're not seeing that is because unlike 2000, where that bubble was blown mostly due to expectations and chasing companies that didn't even have earnings, i.e., so it was P expansion. Today, it's really earnings driven. It's really fundamentals improving sharply. And you're not seeing small cap tech stocks seeing any kind of earnings growth to the extent we're seeing in the large cap space. So I think that difference of market concentration only being in the large cap index today shows you that it is, at least one way to show you that it is different from 98, 99. And it's more fundamental. It's less speculative and less multiple expansion.
So the largest of the large stocks, that concentration has blown past the peak of 2000. But when you look at tech's weight, because you're mentioning differences, tech's weight in the index is about at the same level. So I think this is one of those ideas when you look at it where people are like, whoa, it was 30% of, so a little over 30% of the index today. That's where it was right at the peak of 2000. And that's definitely one of those ideas that I think scares people.
Yeah. And in a sample of one, it's exactly the same. So absolutely. And that's where there are obviously similarities, but that only shows you what's on the outside. It's what's on the inside that counts, Stephen, right?
Very true.
That's where things change.
So valuation, what's different in valuation today?
Yeah. So valuation within tech today sits at around forward PE of around 30 times earnings. So it's certainly high, but not nearly as high as we saw in the late 99, 2000, where it eclipsed 30, went to 40, all the way as high as 50. I think if you looked at a broader index like the NASDAQ, I think we were trading at like 100 times earnings around the peak of 99 to 2000 tech bubble. So we're nowhere near that either today.
And it was a lot of those high multiple companies in 2000 that were leading the way in performance. There are 100 plus PE stocks today. There always are. You can always cherry pick a few ideas. But in 2000, the market was really being driven by those.
Yeah, the weight of them was much greater than they are today. And so one of these stark differences, 180-degree complete contrast from 98, 99, 2000, and the last few years is what are the fundamental attributes of these tech stocks that are outperforming? And it's not only in tech, but this was true in the whole S&P 500. So around 1998, there was a emerging market currency crisis, the Thai baht crisis, and then the Russia default. And that's around where long-term capital management, LTCM, went out of business. And the Fed cut rates 50 basis points. And that really seemed to be a catalyst to kickstart really the final blow off, last couple of years of this blow off in this move in the late 90s in tech stocks and in the overall index altogether. And you saw some of the best performing stocks that were going up the most were the ones without any earnings. And that is so different compared to today, where when we look at stocks in the S&P 500 and even within tech as a basket, they have clearly been underperforming for the last several years, while the most profitable companies that not only have high expectations, but actually have high realized earnings and cash flow, have been the best performers. So the leadership, the flavor of leadership could not be more different from a fundamental perspective. And that's probably why the multiple is not as high, because again, there's earnings supporting the story compared to the late 90s, where most of the upside came from multiple expansion and expectations.
I think that's a really great point there. You had leading into 2000, a speculative run led by the riskiest names. And today it's more fundamentally driven. It's not the most riskiest names leading.
I think just that alone helps us understand what the risks are. When you have a house of cards built on pure speculation and very little earnings behind it and high expectations, it doesn't take much to tip it over. And so in the 1999 and 2000, we can go back and look at the macro data, things clearly started to slow. And as soon as investors got a whiff of the economy slowing, and this was happening while the Fed was raising rates and oil prices were hitting 20-year highs. So there were plenty of factors at play. But basically, once risk started coming back into the markets, being priced back into the markets, the most speculative stuff, as it often does, got hit the hardest. And that was the tech bubble and all of those companies that IPO'd in the mid to late 90s that never really realized any kind of form of profitability or cash flow. Whereas today, one would have to imagine that to break this current tech period of outperformance, at least from a macro perspective, you'd have to get the economy pretty bad because, again, there's a reason why investors are chasing U.S. equities and large cap tech stocks more specifically is because that's where the best fundamental strength is. Thus, they will be able to most likely, from a macro perspective, hang on the longest should any macro risks show up. Very different than 2000.
So in 2000, it was that idea that macro was the major risk.
Well, yeah, and I think there's a debate around that. A lot of people will argue that, well, it was the market starting to go down because the bubble popped that sent the economy into recession. I think that certainly contributed and perhaps propelled the downturn in the economy. No debate around that and the negative wealth effect we saw as stocks started falling. But if you look at the S&P 500, the S&P 500 was pretty much back to its all-time highs by August of 2000 as the Fed started signaling that they were going to cut, and really what put a peak in the S&P 500 and really a second peak in the Nasdaq, which never got back to the highs of March, but certainly I think it had a 40% run up during the summer of 2000. What ended up putting a peak in both of those was that we started seeing unemployment go up, unemployment claims go up, and the economy over the next several months and quarters went into recession into 2001. So today, one of the ways we evaluate the market, we can look at the concentration, which is a big theme and a big topic everyone's very focused on, the concentration of Max 7, the top 10 stocks, et cetera. Heck, the concentration of US equities around the world is extreme in the 70%. One of the charts that, again, is entirely different than the late 90s is measuring the weight in the US equity market of the stocks with the least profitability. So we have this data going back to the 60s. It's from French and Fama. And we're able to look at how much of the US market capitalization is made up by the lowest decile, so the lowest 10% of stocks with the weakest profitability. And over most of the last 60 years, that data or that weight of that cohort of stocks averaged or ranged between, call it 2 and 5%. However, beginning in 1998, probably right around where the Fed cut rates, you saw that cohort surge from about 5% of the equity market capitalization as high as 12%. So when you look at this chart, it's just unbelievably, that's the bubble right there.
What are those numbers again? What is it today versus the peak in 2000 in terms of the percentage of stocks that are unprofitable in the index?
In 99 and 2000, the weight of the least profitable stocks went from about 5% all the way up to 12%. Today, as we sit here in January of 2025, the weight of the least profitable stocks in the US equity market pretty much at all-time lows of about 2% of capitalization. So literally, you were at all-time highs in March of 2000, and today we're at all-time lows. Again, thus the risks are different around this huge outperformance in tech.
Very interesting. So if macro plays a large role in the risk end of the spectrum, and if unprofitable names are most susceptible to changes in economic prospects, we're in a much different place in terms of how much of the index is at risk. A different set of problems, though, because concentration is so high. I think we should talk about that, too.
Concentration is high, but the attributes of that concentration are different. It's kind of like you think about, you can eat 1,000 calories, you can eat a bunch of candy bars, or you can eat, roasted chicken. Both be 1,000 calories, but the quality of those calories could be quite different. So with respect to the tech sector, yes, the composition of the tech weight in the index, and again, that doesn't capture obviously all the Mag 7 names today, but just using tech as a proxy compared to 2000 is similar. But when we look at the beta of that sector in 2000 and the late 90s, it was really high. Today, it's extremely much lower. If we look at the profitability of the tech sector in the late 90s and 2000, it was not even close to where it is today.
The fundamentals for the tech sector have matured so much. You're talking about stocks that pay dividend, have high profitability, incredible margins, piles of cash. It's a much different landscape from a fundamentals, income statement and balance sheet than it was years ago.
Absolutely. And, we could see that on any kind of data metrics. Again, the expectations, like when we look at the long-term growth expectations. So analysts on Wall Street, one of the numbers they estimate is how much a company is going to grow over the next 5 years. And many different data providers like FactSet, Bloomberg, or CompuStat, or IBIZ, they aggregate these data, and then you can roll that up to the sector level, or you can roll it up to the overall S&P 500. So when we look today, what's the median weighted average long-term growth rate of the tech sector? It's at 24, and it's basically, it's about as high as it was in 99 and 2000. The difference, though, is that, yes, we have high expectations. That's similar. The difference, though, is that when you look at the realized fundamentals, so what's the starting point of these companies? We look at, let's say, a factor like ROE. Today, the profitability of the tech sector is around a little above 30% on ROE. In 2000, the peak of the ROE in the tech sector was much lower at about 20%. Yeah. And again, there were companies that were making money in 2009, but it was much narrower than it is today. And again, the companies today that are the most profitable are the ones that are leading, whereas in 99, 2000, it was the companies that were least profitable that we're seeing the kind of returns we're seeing in NVIDIA today and things like that.
Much of the overall index earnings over the last couple of years, not all, but a good portion of the growth and a good portion of why we reached all-time highs in earnings so soon was because of the tech sector and the Mag 7.
Yeah. When did the equal weighted S&P 500 is also at a new high today, but that definitely took a while longer to get there.
And then doing the X Mag 7 took a little bit longer. But when you compound it up and you look at the overall full picture, we got there pretty quickly post-COVID for the S&P 500. It had a lot to do with the Mag 7 and tech.
Of course. So when you're pulling this all together, when we look at, we often think when we think about valuation, a lot of people have different views on valuation. They create fair value models. We try to think about what's driving valuations, because I think if you could get a handle on what is driving multiple expansion or multiple compression, you can understand when you'll see an inflection point. So in the late 90s, when you look at let's say you look at growth to value, which, again, was very much tech to everything else, you saw this massive relative P expansion. But when we look at realized fundamentals, it really wasn't explained by realized fundamentals. It was more explained by expectations. Whereas over the last, really since post GFC, even going back to the middle of the 2010s where FANG was popularized and then became Mag 7 after COVID, the outperformance is really in valuations is really being explained by the outperformance of relative fundamentals. Thus, the outperformance in price is more supported by realized fundamentals compared to anything we saw in 99 and 2000.
Kind of first pass bubble test. Are fundamentals and valuation that kind of trade-off balancing out? So, Michael, really interesting. We talked about fundamentals and we talked about how they are very different today than they were, but that doesn't mean there's no risk today. What are the risks today and how are those risks different than, say, in 2000?
And when you look at the leadership in the late 90s tech bubble, it was much more of a speculative story. It was companies without earnings. It was high beta tech stocks. It was super high growth expectations tech stocks. So it was really about sentiment, much more than it was about realized earnings. And so you could argue that it was much more macro driven than it was idiosyncratic compared to today. And what's interesting is that when you look at tech sector earnings growth, obviously was stronger in 99 and 2000 than the rest of the market, but it did correlate with the rest of the market. We saw better earnings growth in 99 and 2000 in many sectors. And we saw the economy get a lot better in 99 into 2000 after that Fed rate cut. And again, ultimately peaked in 2000. But we did see cyclical data improve, tech earnings growth improve, and other areas of the economy and the market just nowhere near as much. Whereas today, if you think over the last couple of years, 23 and 24, the earnings of tech is not only from a magnitude much greater than anything else, but directionally, you're not seeing any kind of other sectors see this directionally improvement in earnings growth. So one could argue that the current tech backdrop and what's driving it is far less macro driven and therefore at risk of a bad macro outcome than what we had in 99 and 2000, where it was really just sentiment holding up the whole story. The floor is a lot higher than it was in the late 90s.
So it's really interesting in that the risk today is really an idiosyncratic risk. The risk isn't that the economy turns and money starts flowing out of the market. It's really that something goes wrong with Apple's earnings or something goes wrong with Microsoft's earnings, or I could name any one of the Mag 7. That's the big risk. It's an idiosyncratic risk. You break up, you have your market portion of return, you have your idiosyncratic portion. And because of concentrations today, we are so tied in the overall market to these mega names.
Yeah, and if you think about how investors, position, should we see a growth slowdown in the economy, or the fear of a recession comes back at some point. Again, these companies are not doing well because the economy is good or the economy is weak. And I would say that that's more so the case than we did see in 99 and 2000. And we've seen even rates going up. The Fed tightening cycle has always preceded recessions. And in this Fed tightening cycle, these companies made more money because they have so much cash on their balance sheets. Not every single one of them, but in aggregate, they've got tons of money on their balance sheets. And so with higher rates, they're just making more money. Whereas many other parts of the economy, you think of small businesses and other cyclical areas, have seen their net interest expense go up. And so if the economy, as we've seen the last 2 years, as earnings growth was weaker everywhere else, outside of tech, that's where the money chased those stocks. So ironically, I think there's two risks. There is a macro risk, but it's different than I think what we think of in 2000. So yes, I think the biggest risk is definitely idiosyncratic risk, i.e. these companies really mess up or the expectations completely fall out of bed. The macro risk for the crowding in these Mag 7 stocks and tech stocks is really actually the economy just gets a lot broadly better. And you see this booming earnings rebound in small caps and mid caps, and investors completely rotate out into these other companies that massively surprise to the upside. That is not our base case for this year, but that to me is the biggest rotation risk for this large cap growth space or the tech space, is that the opportunity set begins to look much more attractive. The likelihood of that happening with rates staying where they are and the possibility that the Fed's no longer going to be cutting rates is probably lower than higher. Thanks for tuning in to today's episode of What's Next for Markets.
We hope you enjoyed today's episode of What's Next for Markets. You can subscribe to the show on Apple, Spotify, YouTube, or wherever you get your podcasts. Be sure to follow Michael on X at Michael Cantro. If you like the show, please let us know by leaving a positive review. The preceding commentary is not financial advice. You should always seek appropriate financial advice from a professional financial advisor in your state. You should not consider this as a substitute for these services. Piper Sandler does and seeks to do business with companies covered in its research commentary or coverage. As a result, investors should be aware that the firm may have a conflict of interest that could affect the objectivity of this commentary. Investors should consider this commentary as only a single factor in making their investment decisions. For full disclosure information, visit www.pipersandler.com/researchdisclosures.